So we're now going to look at doing a profit and loss table for the put option insurance strategy. So again, what we do is we describe our trade in detail. It's always the very first thing you should ever do when you're doing a profit and loss table. So we've two trades here. The first trade is we bought the Microsoft shares at a price of $47 and we bought 100 shares of that. So that's the first trade you enter. And then the second trade we did, we bought a put option expiring in July at the $60 strike, and we paid $4.60 for that, and we did one contract, because remember, in the options market, one contract controls 100 shares of stock. So that was our insurance policy against a fall in the share price of Microsoft. So at the time when we placed the second trade, the share price was $56.38, and our target price for the stock to the upside is $65. So you'll note that even though we bought a put option here, we still have an upside bias on the stock position. We want the share price to rise. The put option is simply to insure us against any downside falls in the share prices. So then we get into our what if scenarios. So this is where we say, well, what would it mean if at expiry for the put option the share price was at $40? What would it mean if the share price was at 42, 48, and so on and so forth? So they're what if scenarios for share price outcomes. So the next step we do is we enter the information. We know that we paid out $47 for the stock. So no matter what happens to share price, that will never change. We've paid out $47 for the stock price. The next thing is we know what we paid out for the $60 put option that we bought for Microsoft, and we paid out $4.60 per share. So that's a cost. No matter what happens to share price, that cost is always fixed for us. But here's where we've got to enter some information down here, because we're now saying we're at expiry Friday and we want to put a value on the put option that we own. So if the share price is at $40, the value of that put option will be $20. It's in the money by $20. So why is it worth $20? Well, think about it. You have these shares of Microsoft. This put option is allowing you sell them back to the market at $60 no matter what happens. So if the share price at the time is only $40, that means there has to be $20 of real value in that put option. At 42 there's $18. At 44 there's $16. If the share price goes to 46 there's $14, and so on and so forth. So you'll notice when we get up here to the end that above 60 there's no value in these options. That's because the put option is now either at the money or out of the money, and when a put option is at the money or out of the money at expiry, when there's no time value left, there's no real value whatsoever in that put option. So all we do then is work out our profit and loss on a per share basis. So all we have to do here is add up these four columns. So we're saying here, right, we bought the shares at 47, they're now trading at 40, we bought a put option at 460, and the value of that is 20. When you add those four columns up here, you get a profit and loss on a per share basis of $8.40 per share. You'll notice it's exactly the same at the 42 outcome if the share price drops to 44. So you can quickly see here that by buying that put option, we've absolutely capped our downside potential. And in fact, because the shares had risen so much for us, we're going to make a profit no matter what happens. But when the share price starts to rise again above that $60 level, you're going to see that our potential profit goes up again. So this is exactly demonstrating to you how powerful by buying a put option against stocks that you own can save you from any downside risk in the shares. Now, the next line, all we've done is worked it out on a per contract basis. So that's simply multiplying your profit and loss per share by 100, because in the options market, one contract controls 100 shares of stock. Then we will talk about the profit and loss on a per trade basis. Now that's exactly the same as the per contract basis here, but let's say for argument's sake we owned 300 shares of Microsoft and we did 3 contracts here. Obviously all of this would change here. We would simply change the quantity up here. So that would automatically change to 3 times what we have.